All right, we have a few people in the room. I'm just wondering if you could let me know if you can hear me and if you can see my screen. You should have a chat feature where you can let me know if everything is working okay. Greg says all good. Excellent. Nice to see you, Greg. Hope you're doing well. All right, so today we're going to talk about Bollinger Bands. Before we get started, I just have to go through the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leverage products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, you already know me. If you've been around the FCI blog, or if you've read any of our output, my name is Justin Paolini. I've been head of trader development here at FCI Markets. Previously, I was issuing institutional grade analysis through 3C analysis. I spent most of my career on the retail side, which means I've made possibly every mistake in the book twice, and I'm in a better position than many to help you achieve consistency in your trading because I've been through almost everything there is to go through in terms of mistakes. But I survived and I graduated onto the institutional side, and that's why I'm here. So our objective here at FCI Markets with everything we do is not just to give you a bit of information about trading and techniques, etc., but it is to help you become a consistent trader so that you can join our desk either remotely or in person if you live in the UK, because we have a funding program, because capitalization is one of the biggest issues for traders. A lot of traders sort of blow up their accounts because they try to over leverage their very small accounts because they try to make a living by trading a micro account, by trading, $2,000 up to 10 grand and trying to, make 100, 200 euros a day or $200 a day off of that. And just to make those kind of returns with a small account, you have to push the leverage on your account, and it just deteriorates your psychological capital. It really pushes the boundaries on sustainable trading habits. It really puts the focus back on win rates, and that just takes you down the wrong roads, and it takes you into the dead ends, and you might never recover. So what we are offering is, if you are consistent with your trading habits, or if you come to our academy, or if you get in touch with us and over time you do develop a certain consistency in your trading, then we can fund you. You can trade our capital and get a profit split. There's no fee. This isn't like one of those typical prop trading gimmicks that you see on the net where you pay to trade the demo and then maybe you can trade live, etc. No, we evaluate your trading records, and based on merit, we can allocate real capital up to £1 million. Obviously, if you're starting with a small account, the initial allocations will be smaller, but they can grow based on your consistency. And if you're at all curious, just come on over, register your interest, and we can discuss the requirements, any statistics you already have on your trading, anything at all. And if you have any other questions, of course, you can write to me or you can write to us at FCI Markets, and we will answer all questions. But the idea is that all of our education is here to help you become a consistent trader and receive funding from us so that you can become a professional trader in a sustainable manner. Okay, that's our main goal. So with that said and done, we're going to talk about Bollinger Bands today. And the premise to this presentation, as with many that I've done before here, is that with all the information that's out there regarding trading, there are 10,000 odd books, and I've also published a book on trading. You can find it on Amazon. It's called Building a Trader. But there are all sorts of books that have been published, all sorts of free information, and some of it's also good information on the net. then why do we consistently see this? This is a chart from my FX book, and it shows the aggregate positioning of retail traders on the euro. And you can see how during the upswing, now this is a bit dated, this is back to the end of July, but it shows the concept, right? Traders in aggregate are short the euro during this upswing. Okay, you can see the short positions greatly outweigh the long positions. So of course there are some traders that are on the right side of the market, but they're always the minority. And the question is, why does this still happen? Why do traders continue to fight trends and fade momentum? Okay, and so what I'm trying to do here with all our webinars and everything that we put out is to help you stay on the right side of the market and avoid getting into trouble like this. One reason, and this is key to today's conversation on Bollinger Bands and on technical indicators in general, but I think one reason why traders get into a lot of trouble is because they use technical analysis to justify their own views. Like they want to see something, they want to deploy their own view on the market, they want to force the market to do something, and they use technical indicators or they change their technical setup to justify their view. Okay, and you can see this. I mean, I've taken these screenshots from TradingView. I'm not targeting anybody in particular on TradingView. I just went and got some screenshots because it's just a common habit. You see this all the time, with traders that they're constantly learning and they're sort of never earning because they just go around in circles. Okay, and this guy here is also using Bollinger Bands, but he's using it to call a top for whatever reason. And it's just, you see this over and over. So with this being said, when we talk about Bollinger Bands, we are going to talk about the principles and how you can use them to generate a useful structure within which to view the markets, to understand the markets, because everything that we put on our screens, everything that we add to a chart is to help us make sense of the chaos. Okay, but you have to know the pros and cons of whatever you use, and you also have to know, how to read the market without, that particular piece of eye candy. So John Bollinger himself said that asking the market what is happening in the here and now is always better than telling the market what to do. Now, a lot of traders, like we saw before, try to tell the market what they want it to do. And they use technical analysis to sort of force their own views on the market or to see what they want to see instead of observing what is actually happening. And Bollinger Bands are a useful tool to understand what is happening, because Bollinger Bands take into consideration not only trendiness, but they take into consideration volatility as well. So here's a basic screenshot with Bollinger Bands on it, and I'm just going to describe a little bit about what Bollinger Bands are, how they're built, etc. So Bollinger Bands are basically a volatility metric, and they oscillate around a 20 daily moving average. So this is a 20 DMA right in the middle, and the 20 DMA seems to be interesting even nowadays. There are some empirical theories that the longer term players look at the 20 DMA or the 21 exponential moving average, more or less around there, basically the average of the past month of trading. And that's when they sort of stick their finger in the air, trying to understand whether the fundamentals have changed or whether the fundamentals remain more or less where they were. So the 20 DMA does have a little bit of significance, but John Bollinger himself said that even if this is a starting point, the average is just, it's an average, and you can play with the average, or you can use whatever average best suits the conditions at the time. Okay, so it's not set in stone. It's not the Bollinger Bands must be with the 20 DMA. I've used 13 DMA. I think the 13 DMA is useful as a criteria. I think it's underestimated. But again, it's just a facilitation. It's not a secret to trading. Just like no technical indicator will give you, any particular edge. It's you that has to actually learn it. So we're going to learn more about Bollinger Bands. So how are they built? You've got a central line, which is in this case the 20 DMA. And then you have the outer bands, which are placed, in this case, at 2 standard deviations from the mean. So standard deviation, statistical measure, is basically to describe the variability, how much oscillation there is and how wide the oscillations are around, this 20 DMA. So statistically speaking, if the markets were to move with a normal distribution, okay, if the distribution of the returns of the market were normally distributed, Bollinger Bands would encompass a fair amount of trading. But unfortunately, it's not that simple. The markets are not normally distributed, and because they have thick tails. So that's why you see price climbing up the top band, or it can be climbing down the bottom band. So in these trending market states. Okay, and this is why Bollinger Bands, I think, frustrate a lot of traders, because when you smack a bunch of bands around price, our minds, for some reason, tend to gravitate towards reversal plays. So the bands sort of, they lean towards calling tops and bottoms. And I think this is one of the main reasons why Bollinger Bands can do more harm than good if you don't understand this, and you don't understand how our minds work and what Bollinger Bands are really useful for. Okay, I don't think they're useful for calling tops and bottoms. I think they're useful for generating a context, okay? Because when you see the bands expanding and when you see price crawling up on the top, automatically it tells you that price is starting to get extended. So on one hand, you know the price is trending. On the other hand, you know that these trending states, they don't last forever. And actually, in foreign exchange, they're not the norm. They're rather the exception. The markets tend to trend 30 to 40% of the time, and the rest of the time they're in a range. So, these trending states obviously are great to trade, and we'll see how to trade them. We'll see how to anticipate them using the bands. But once it is in a trending state, don't focus on calling tops or bottoms. Okay, ride the trend until you do start seeing, some toppish behavior, some strong rejection from the band. Okay, or divergences. We'll talk about that later. But you need to understand what state the market is in, and Bollinger Bands help us describe that. So that's just the first word of caution. Don't use the bands to blindly call tops and bottoms. In my experience, it doesn't help. It doesn't work. It'll do more harm than good. But instead, use the bands to generate a context. So we are rising, but instead of rising, for example, from the moving average here, where you have space till we get into extended territory. Okay, so you basically, any longs from down here from the moving average have space to go before they hit the continuation points in the top band. When you're riding the top band, it's in a very strong trending mode. So, so you might want to use the smaller time frames to get into pullbacks and to skew the risk reward in your favor. And you actually have to do that in these cases. But you have to understand that the market is trending. That's the state that it's in. The bands help you understand the state the market is in. So you don't want to go fading it and fighting this trend. But the other thing I wanted to talk about in terms of Bollinger Bands is how the volatility component, the standard deviation component of the bands, is a precursor to trending market states. So what I've put down here is the bandwidth. Now the bandwidth is just telling you how wide the bands are. And what I want you to notice is how almost every trend, okay, nothing works all the time in the markets, but there are some things that work often. And this is one of them. When the bands contract significantly, okay, you can visually see it because the bands, they're contracting, but this indicator really helps you focus on that dynamic. Okay, when the bands contract, the market is obviously compressing. It's coiling like a spring. And that energy that the market is generating as it contracts, as it goes into the volatility contraction, will have to be released. So that is why the volatility contraction and the bandwidth is possibly one of the most useful components of Bollinger Bands, because when the market contracts, you can see it visually. And I would encourage you to go onto your MT5 or MT4. There are free indicators. The bandwidth is very standard. You might even have it in your charting package. But if you don't, you can get in touch. We have it. It's free. The bandwidth can help you observe this dynamic. And all you have to do is go back and study this to see how accurate it is. The markets contract. Okay, so what I've put is I put a line here, 200 pips. That's basically the distance between top and bottom band on the euro, and 200 pips is a reasonably low measure for the bandwidth on the euro. And what you'll notice is when the thing is contracting, once you have a close above, okay, you can see the volatility expansion, nice long candles once again, and a close above the top Bollinger from the contraction, that's when the trending market state starts. And you can see after this consolidation pattern, there is another volatility contraction. And once again, when we have the close above the top Bollinger, the trending market state starts once again. Okay, now we had a little one down here. Okay, contraction, you can see the Bollinger bandwidth is highlighting the contraction. And then we have a bit of volatility here on the daily candles, that close below the bottom Bollinger. And so the trending market state is engaged, and for a few days it actually trends down. Okay, you'll never know how far the trend is going to go. But what you do know is that when you do have a contraction, as we are seeing, well, actually, as we saw before I made this presentation, okay, you can go and check the euro now, and you will notice that we've broken through the top, and we're in a trending market state. So you can see that these contractions are an easy way to spot these potential trend initiation points. It's really simple, and simple trading models are underestimated by the community. Okay, and then of course the entry trigger, so this volatility contraction trigger here is useful to get you on board, or it's useful to generate the signal. But then of course the other components of your trading model, so the actual execution, the risk reward, trade management, all of that goes to complete the puzzle and help you make the most of these trending runs, whether it's long or short. Okay, and we've done previous webinars on that. I will be doing a webinar next week on how to maximize your the efficiency of these trending market states and of these signals with the Bollinger Bands. So stick around for that. But let's go forward. So volatility is the main ingredient of these Bollinger Bands. The bands are very quick to adapt to the changing market environments, and they also help us understand when price is relatively extended. Okay, now note the term relative, not in absolute terms. And that's why you shouldn't call tops and bottoms with Bollinger Bands. The bandwidth is quite useful to help us identify the squeeze setup that we've just seen, which usually signals the start of a trending market state. And then the average line is useful for pullbacks. For example, if you go and read Street Smarts, Linda Raschke designed a setup around the 20 daily moving average within a trending market state. And basically, it's just playing pullbacks to that 20 DMA. And you can see that here. After the market sort of breaks out, pull back to the 20 DMA. The market is trending, pull back to the 20 DMA, right? And it's a swing technique, basically. Same thing back here. Okay, so the market breaks down, pulls back to the 20 DMA, and then it returns down to the downtrend. Okay, so it's another useful component of the Bollinger Bands and how to use that 20 DMA to look for setups in your favor. The other thing is that the corridor between the first and the second standard deviation is useful for momentum trades. Now we'll see that in a bit. What I've done here is I've highlighted just the squeeze. Okay, the squeeze setup we talked about before, and you can see how it's just quite evident. The market closes above after being in a contraction. The market closes above the top Bollinger, and it engages trending market states. And it really is a simple way to set your stall, okay? Especially if you're trading around a day job, especially if you have a limited time availability to trade the markets. Just waiting for these volatility contractions to set up and then waiting for the expansion to start, trying to trade in line with that expansion is such a simple way to trade, and it is so underestimated by the retail community. They go and look for much more complicated things, and in reality, this just it's we've actually tested it statistically, and it leads to a certain amount of profitability. The Sharpe ratios aren't fantastic if you trade it systematically, but with a bit of discretion, with a bit of experience, you can get Sharpe ratios above 1 simply by trading this on daily charts. And it gets even better if you can use the sub-daily charts like the hourly chart, or even lower, 15-minute, to fine-tune your entry and get a much better risk reward. And we'll see that next week. I'm going to do a webinar on how to do this next week. But here's something else, okay? And this should help you understand why I'm showing you certain techniques and not others. Since most retail traders are on the wrong side of the market, they are punctually on the wrong side of the market. I'm showing you things that keep you on the right side, and as you notice here, you will be punctually on the right side doing exactly the opposite of what most people are doing. Okay, now notice here, I put the arrows on the volatility expansions, okay? The 3 expansions we saw before, 1, 2, and 3, that's where they are, 1, 2, and 3. Now, look at what the retail community was doing, okay? As the market was breaking out, the retail players were sort of undecided here whether to go long or short, but then when the market breaks out to the long side, they flip to short. And they remain short to different degrees all the way through, okay? And then in the choppiness, they reduce their positions. And when the market breaks out again, after that second volatility contraction, that's when they increase their shorts. And vice versa. When the market, after this extended contraction and range-bound market, starts to break lower, that's when they were starting to flip to a long position. So this should give you confidence. If most players lose, okay, if most traders lose when they try to trade, then we should try to do exactly the opposite of what they're doing. And trading the squeeze, okay, trading in line with that volatility expansion, gets you doing exactly the opposite of what most people are doing. So that should really give you, it should entice you to try it, because most traders lose. Most traders fight trends. And instead, trading the squeeze is a stark contrast to that behavior. Okay, it gets you much closer to profitability. Okay, it gets into that trend following mindset and not into the fading mindset. It's extremely simple to spot. Okay, so it's an efficient way to trade. And the edge comes from your trade execution and your trade management, because it really isn't enough to just execute this off of the daily chart and hold and hope. You do need to know how to manage the trade to maximize the profitability you get from these opportunities. Because, of course, trading from a daily chart, these opportunities don't come around very often. Okay, they might come around once a month, or if you're trading, 8, 9, 10, even 15 pairs, you might have, 3 or 4 trades per month. But, you need to maximize those trades, those opportunities, in order to really get the your Sharpe ratio up. So next week I'll show you how to do that. But let's just go forward with another setup. When we talk about trend trading and that the famous, the holy grail setup that Linda Raschke was talking about, it's another extremely simple way of using the bands. Okay, remember that the bands, the 20 DMA really gives you the direction. Okay, so above and beyond anything else you want to put on your charts, if you use the bands, then I'm taking for granted that you're just using the 20 DMA as your directional bias. So the 20 DMA gives you the direction. And if you're trading the trend and trading the pullbacks, what you want to do is wait for the pullback to the band, to the moving average, wait for some kind of price action signal, and try and get aboard. And and scale out and do the same thing and add when it comes back to the band, and scale out and add when it comes back to the band. One thing that I find useful is just to use this in conjunction with an oscillator. And I've put a CCI, Commodity Channel Index, a 6 period. You could use a stochastic. You could use a rate of change. You could use a MACD. It doesn't really matter what you use as long as you can, as long as you have a good feel for it. Okay, as long as you actually understand and you like the indicator you're using. But all of these momentum indicators will show you approximately the same things. So what I like to see is I like to see a pullback to the moving average when the oscillator is at or beyond minus 100. So it's an oversold. Now we didn't quite get there on this, in this phase, but we did over here on this pullback. And so that is basically one of the best signals for playing a pullback. The triggers, you can deploy whatever trigger you want, but that's the setup. Oversold, back to the average. The average doesn't break. The average shows a bit of rejection. So the next day you're looking for a re-engagement of the long side, and your initial target is the previous swing high you're coming back from. Really simple stuff. Same thing over here, oversold. Okay, and you have the market stalling at the average. Okay, a bit of rejection here. You can see this, a bit of rejection. The market is stalling, and then the strong candle body showing you the momentum is re-engaging. And this didn't just stall at the previous swing high. It actually broke through. And this is, these are the kind of trades that you really want to milk. So it's really simple. Okay, using the average within a nice trending market state can help you to play the pullbacks to the band instead of just playing the volatility expansions. So it gives you an alternative. So here are some rules to use the bands to your favor. For an upside bias, okay, so in order to look for pullbacks to the moving average to the long side, wait till the average is broken to the top side and turning higher. Okay, so it's not just enough for the market, for example, to break through the moving average. Where's a better example? Here's a better example. Okay, so the market breaks down through the moving average. However, the moving average is still sloping up, and that's important because remember, the average is what gives you the trend. So just because the market is breaking below the average, that doesn't mean that we're flipping our bias to short. We actually wait till the average changes to the downside. So we need a bit of downwards momentum before we can actually call the trend a downtrend. So that's why the average should be broken to the top side for an upwards bias, but the average should also be turning higher. You should also see an increase in topside volatility. Okay, now what this means is basically you want to see strong directional movement rather than insipid movement. Okay, this kind of action is just showing nothing. Okay, the market is stalling around the average. Okay, what you want to see is strong directional movement. Okay, strong directional movement. This is, and basically all you need to do is see the length of the candles. The length of the trading day will already tell you a lot about the strength of market participation and momentum. That's all you need. So that plus the average sloping down or up, and price moving towards the upper band if it's going up, moving towards the lower band if it's going down. Really simple rules. Once again, totally underestimated by the retail community, who think you need to do something much more complex. But the best trading systems, especially the systematic models, are usually very simple. Okay, the less complexity, the better it is. So here's the third idea that I'm feeding you today on how to use the bands. The momentum corridor. And I'd actually built an indicator on this a few years ago that would allow me to scan all of the FX markets based on where they were, whether they were in the top band, the bottom band, or in the middle. The idea of the momentum corridor is that when the market is at first standard deviation band and the second, okay, so in this top corridor or in the bottom corridor down here, whoops, sorry, it's pressing in line with the trend. So you don't have to ask yourself anymore, what direction should I trade in? Where's the market going? What should I do? You already know. And you know that it is a momentum corridor. So you also know that it is a strong market state to trade in, and that you should have accelerated moves in your favor, whether you trade on the sub-hourly timeframes or the hourly timeframes, right? The market should move quickly in your favor. So it isn't for pullback trading. That's what I'm saying. It's not for pullback trading. This is for getting in and trying to milk a momentum move. So when the market continues to push in one direction, okay, the moment it closes back below that corridor, you are no longer looking for this kind of setup. Okay, you're out. You're waiting till the market breaks into the corridor, and then you're looking for the extension to the top side. Okay, and vice versa to the downside. Okay, so here's when the market closed inside the corridor, and in the next few days you can see that it dropped significantly. And the same thing here. It closed in the corridor for a couple of days, it dropped significantly. So obviously, once again, this is the signal, and then your trade management and how you actually execute and manage the trade is what will really give you the additional benefits. So, and we'll see that in next week's webinar. So this week I'm giving you the ideas, right? The signals. So the squeeze, trend trading with the bands, and the momentum corridor. And then next week we'll see how to exploit them using different time frame combinations and skewing the risk reward strongly in your favor. But I guess the principle remains the same. It's really simple. I mean, every charting package has Bollinger Bands on it. And you can change the settings and put a 1 standard deviation and a 2 standard deviation and just observe it for yourself. And you will notice how it's extremely simple. And once again, okay, this is the chart of cable like we were seeing before. Observe the behavior of retail players as the market enters the corridor. Okay, so just one more time. Remember where the corridors were active. So up, and then I guess we have a bit of downwards movement here. Then we have a bit of upwards movement, then the big upwards move. Up, this was choppiness, okay, but I guess you can look at that as well. Bit of upwards movement here. Now look at that alongside retail positioning, okay? A bit of downwards movement that we were seeing. Oh, first the upwards movement that we saw before, and retail positioning is short. So they're fighting it. A bit of downwards movement in the corridor. Retail players are switching to a long stance, fighting momentum. Then we had the upwards movement here, and retail are switching to a short stance, to an aggressive short stance. Okay, and once again, we had a bit of upward movement here in the corridor and here, and retail players are strongly short and short. When we get to the bottom corridor, looky, retail traders switching to a long stance. Okay, so I wanted to show you how even with the momentum corridor, you are trading opposite to common retail trader behavior, which is a good thing because most traders lose, most traders are punctually wrong, and so we should be inverting their bad habits. Number two, the momentum corridor gets you into a trend following mindset. The same as the squeeze, the same as following the squeeze. The momentum corridor is simple to spot, so it's efficient. Okay, and once again, the edge comes from execution and management. And that's why a lot of traders take it only this far. They say, okay, momentum corridor, great, I'll use that, use it on a daily chart, and they don't really get very far because it's in the execution and management where you can really maintain your profitability when you use these techniques. So here are some rules by John Bollinger himself to help you understand more about the limitations of the Bollinger Bands. Okay, when the market touches the bands, okay, it's not a signal. Okay, the market is just touching the band. A tag of the upper or the lower Bollinger Band is not in and itself a signal. And that's where a lot of people go wrong using Bollinger Bands. They try to fade tops and bottoms. Okay, now I'm not saying that it can't be useful. The Bollinger Bands can be useful for fading tops and bottoms in conjunction with overbought signals coming from another indicator, an oscillator, for example, and some price action. Okay, so you get the context from the Bollinger Bands. The markets are a bit extended, but then you have to qualify that. Okay, and using a bit of other inputs is what is required. But too many people, I think, just sell the top band, buy the bottom band, and that's as far as they go. And John Bollinger is saying, don't do it. Then, when the market closes outside the Bollinger Bands, as we've seen with the squeeze, okay, these are initially continuation signals, not reversal signals. And I can tell you from experience, I've seen a lot of players that automatically take that as a fade. The market closes outside the Bollinger. Okay, great. It's extended. Let me fade that. And once again, it leads them to nowhere. So, remember that when the markets do expand, especially when they come from a volatility contraction, we like to see the closes outside the Bollinger. We like to see that strong momentum. We like to follow that. Then, make no statistical assumptions based on the use of the standard deviation calculation in the Bollinger Bands. Okay, this is what we said before. The distribution of security prices is not normal. Okay, it's not a bell curve. It has fat tails. So that's why the markets can and do close outside of the Bollingers and push directionally for an extended period of time. Finally, Bollinger Bands do not provide continuous advice. Rather, they help identify setups when the odds may be in your favor. Now, this is exactly what I've given you in this webinar. I have given you 3 setups, okay? 3 moments when the Bollinger Bands are useful. So number 1, when there's a squeeze, when there's a volatility contraction, the markets usually expand and trend for a certain amount of time after volatility contraction. The second thing is trading the pullbacks within a trending market state, trading the pullbacks to the median line, to the 20 DMA in this case. And the third, trading the momentum corridor, okay, for fast-moving markets, for traders that don't like to sit sit through pullbacks. Trade the momentum corridor, okay, because the market should move fast, and if they aren't moving fast, then you get out and you stand aside, because that's not the logic of a momentum move. So the Bollinger Bands are useful for identifying these market states, but they're not used as a forecasting tool. They're not used for calling tops and bottoms. They're used to give you information on the present market state. And it helps keep you on the right side of the market if you do it properly. And funny story, I used to know a dealer, a foreign exchange dealer, and he was profitable. For many years he was profitable, and one of his main tools was the Bollinger Band. And the only thing that happened is that he started to fight a trend, and he fought a trend in the Swiss franc. And I'm not talking about when the Swiss National Bank actually pulled the rug from beneath the floor in Euro Swiss many years ago. This was before that. He was fighting a trend in the Swiss franc, and he would try to average down his position on every touch of the higher time frame Bollinger Band. So he went from using a 4-hour to a daily to a weekly, just averaging down his position, and he finally found himself in such a big hole that there was nothing else he could do, and he eventually had to throw in the towel. And the total loss was around 250,000 euros, or something like that. Now that is what happens when you start to believe in an indicator so it's like believing the indicator actually gives you some kind of information on the market that other people don't have. And instead of using it to generate a context and helping and trading within that context. So it can be very hard fighting the market, using the Bollinger, trying to pick tops and bottoms, switching time frames just to justify the fact that the market may turn around on the touch of the other Bollinger. You can get into a lot of trouble if you do it that way. And that's why, from personal experience, I suggest following the market. Use the squeeze, trade the trend, trade the momentum corridor. That way, you're using the bands to generate that context, and you're not trying to pick tops and bottoms or fade market moves. Okay, so here are some questions that you can use to keep you on the right side of things, okay, when using the bands. Is the market going anywhere in an evident manner? Okay, and you can use the direction of the median line of the daily moving average to help you with this. You can also check the bandwidth to look at volatility considerations. Okay, is the market expanding in an uptrend with expanding volatility? That's one context. Or is the market trending, but volatility is very low, so the bands are very narrow? Okay, just like up here in the Aussie dollar. All this trendiness happened in a very dormant market state. Volatility was very low here. So we were trending, but volatility was very low. And these are, some people love these markets because they just trend and they slowly move up. But if you're looking for immediate profitability and strong momentum, these are tough markets to be in. So it depends on what your personal preference is. But this is how you note a low volatility trending market. The bands are parallel. The average is inclined, but you can see the candle sizes aren't really large. You have the occasional volatility boost, etc. That's different than the expansion when you have strong momentum. And I always favor trading this kind of market because you get a lot more bang for your buck. You get a lot more movement. So any potential entry has a lot more forward potential in it as volatility expands. And that's why I do like the squeeze. I like the volatility contraction a lot. So back down here, market drivers. By understanding drivers, okay, by understanding the influences that are driving sentiment, right, from on a day-to-day basis. So what the market is focused on. Right now, it's all on this U.S. fiscal stimulus, for example, and Brexit. Those are the big ones. And then we have the U.S. elections coming up. But fiscal stimulus has been driving people crazy. I mean, the markets are risk on one day, risk off the other. And the only way to stay in touch with that is to realize that right now, markets are generally choppy until we have a resolution of these situations. So a resolution on Brexit on one hand, a resolution of the U.S. fiscal stimulus on the other hand, and finally the U.S. elections. So understanding the drivers and what the market is focusing on is important because let's say you do see a pin bar off the top of a Bollinger Band and it looks really good. Okay, what do? Is that a reversal signal? Is the market extended? Should you trade following that reversal signal? Or should you just stay flat until the trend resumes? Knowing the driver, knowing if that pin bar, if that previous day's action was caused by some influential piece of news, or whether it was simply normal market transactions, that makes all the difference. That can, knowing how to discern between a fundamentally influenced move or just normal profit taking will change your profitability. It makes the difference between a loss and a profit. It really does. So the drivers are influential. And then are there any elements of caution? So if we were trending, is there a squeeze? Is volatility contracting? And so we might, you want to pay attention to this. Has there been an extended run up or down the bands? Because the market can trend, okay, and the market can trend further than we can expect it to. But let's say we have 7, 8, 9, 10 closes in a row atop the band. What is the probability of the market continuing to trend in that direction? Okay, the probability continues to decline. And once you do have a reversal signal, you might be able to get some short-term trades against the main trend just because the market has this extended run. And now it's starting to, profit taking is starting to come in and the market is starting to retrace a little bit. So this context is important. It really does help you stack the odds more firmly in your favor. And then when you're trading, independently from the setup you're using, is there any news that you want to take into account? Okay, for example, trading the pound recently has been fairly challenging because the pound has been boosted up and down, left and right on Brexit speculation. One day Boris Johnson says one thing, the next day Barnier might say something else, the next day Gov might say something. So it makes it more challenging. And paying attention to that and knowing whether you're trading in a normal market condition or whether there is important news coming out, that helps. It really does help. And then finally, what is the risk reward of trading in the here and now? Okay, now we will go more in depth on this in the next webinar next Thursday. But what is the risk reward of trading during an extended run up and down the bands? Now vice versa. What is the risk reward of trading the breakout, the initial break after a squeeze? Okay, what is the risk reward of playing a pullback to the main line, to the moving average? Okay, the different risk rewards of the different. It's not just about the signal. It's about the quality of the signal and how much forward potential there is in that signal at that time. So I hope these questions will help you to understand the context when using the bands. I hope the 3 setups that we looked at today are useful. And I wanted to encourage you to keep things simple and consistent, whatever you do. Okay, it doesn't matter whether you don't use the bands, whether you use the bands, whether you use something else, whatever you do, keep it simple and remain consistent. So that when you do produce your trading statistics and whether it is on MyFX book or whether it's on any other, whether you keep a trading journal by hand, your statistics and the information your trading journal will give you is only useful if you remain consistent, if you're doing the same thing time over time. And so those statistics really do paint a picture of what's working and what needs improvement. So next week, we'll be talking about tilting the odds in your favor. We will use these setups using the Bollinger Bands. We will drill down into smaller time frames and we'll see how we can stack the odds more firmly in our favor by getting tighter risk placement against the same daily forward potential, okay, is to really get those multiple R runs when these situations do appear. Okay, so don't miss that. I look forward to seeing you there. And in the meantime, if you do need guidance, then the first thing to do, subscribe to a Thought Leadership blog, and you will get all the information that we disseminate into your inbox directly. Follow us on Twitter. We put out only the most influential market-moving news and the occasional chart. I made a free course. If you're interested in taking things to another level, you can subscribe to our free course. I condensed all my 15 years of trading experience into 12 very concise lessons. So I hope you'll pick that up and it'll help you on your path to trading consistency. And finally, if you are really serious about becoming a professional foreign exchange trader and getting funded, then come on over to our academy. I teach directly in the academy, and I want you to know that successful graduates have a privileged route towards funding opportunities. And you have a performance revenue share, you have access to institutional grade analysis. It is this is the fast track to getting funded and becoming a professional trader. So again, if you have any questions, come on over, flip us an email, or just visit the site fci-markets.co.uk/academy, or you can write us at client.support@fci-markets.co.uk. If you're in the UK, give us a call, and whenever the curfews are lifted and whenever this COVID madness allows us to, just drop on by and pay us a visit. we look forward to hearing from you. At this point, I'm going to open up the floor for any questions. If you have any questions at all about, about our offering at FCI Markets, funding, the Academy, anything at all, the next few minutes, we'll just open the floor to any questions. You're very welcome, Michael. I hope it was useful. So we have a question on, do you teach Bollinger Bands in the Academy? I have to say yes. One of the setups that I use myself uses Bollinger Bands. I will be showing, I guess, a bit of that next week when we talk about trade setups and how to actually execute these trades. But yes, Bollinger Bands, I find them useful in certain occasions, and some of my setups do rotate around using the bands as well. So yes, we use them in the Academy. Yes, we will send you the link to next week's webinar. I will be issuing it also on our social media channels later today. And yeah, look forward to seeing you next week. But if you have any questions, remember, if you have any questions, you don't have to wait till next week. You can write us at client.support, and you can also write me directly. My email is justin.paolini@fci-markets.co.uk. All you have to do is click on one of our morning notes on our Twitter channel, and you should see my email directly in there. Yeah, the pullback. I like the idea of pulling back to the 20 DMA. It's a really simple setup. I mean, it's a daily pullback, and all you need to do is wait till the market is trending, and wait till your oscillator is showing overbought or oversold, and look for that price action around the 20 DMA. Some people use the 21, some people use a 20 exponential, 21 exponential. The bottom line is that more or less it's 1 month's worth of trading. It's the average of 1 month's worth of trading. So even the longer term players pay attention to that. And it's about the context. It's about doing what's appropriate in the context. And if the market is trending in an evident way, then yes, playing the pullback and not getting caught into that reversal mentality is useful. All right. If there aren't any other questions, then I will wrap this up. I'm going to thank you for coming today. It is always a privilege to be able to be here and assist you with your trading. If you have any questions or concerns, just let us know, because we're here to help. I look forward to seeing you in the next webinar, and I hope this was both educational, instructive, and also fun. This is Justin Paolini for FCI Markets. Over and out.